Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing QuantumScape stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. QuantumScape is developing and testing solid-state lithium metal batteries for electric cars. Lithium-ion batteries currently used in smartphones, power tools, and EVs use a liquid electrolyte solution. A solid-state battery uses a solid electrolyte, not liquid. Lithium-ion batteries are more likely to get damaged. They may swell and get larger caused by temperature change, or leak caused by external force. Solid-state lithium batteries are far superior, but no one can figure out how to mass produce them. They are safer and charge faster than lithium-ion batteries. This company is backed by Bill Gates and Volkswagen. In 2012, it began working with Volkswagen. In 2018, Volkswagen invested $100 million into the company, becoming the largest shareholder. In the same year, Volkswagen and QS announced a project to prepare for mass production of solid-state batteries. In June 2020, VW made an additional $200 million investment into QS. The company's partnership with VW will help a lot since VW made almost 9 million cars in 2020. Also, they plan to invest $41 billion into electric mobility with plans to develop 70 EVs. The company is working with many other car manufacturers, but VW takes priority. They're the first to get this battery, and when VW is satisfied with the results and is able to implement the battery into their cars, then this company can start selling to other car manufacturers. QuantumScape was funded by a SPAC. A special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. On September 3, 2020, QS announced a merger with SPAC Kensington Capital. As a result of the merger, QuantumScape received $1 billion in financing, including funding from VW and the Qatar Investment Authority. The transaction was completed in November 2020. On April 15, 2021, hedge fund Scorpion Capital announced their short position in QS, accusing the company of being a pump and dump scheme. Scorpion claims that no one can figure out how to avoid dendrites from ruining batteries, even though QS claims it is the first company to figure out how to avoid this problem. Dendrites are metallic growths that short the battery and cause it to fail. This issue has been known for over 50 years in the industry. The company is headquartered in San Jose, California, and was founded in 2010. It trades on the New York Stock Exchange and Mexican Bolsa. Let's get started with the model. This is a large cap company, 10 billion market cap. They're trading at $24 a share, and they have 423 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have negative free cash flow each year since they're pre-revenue. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's also negative every single year. This is the company's income statement. The top line is the revenue, the sales. Below that is their operating expenses. These are all their expenses to run their day-to-day business. Since they have no revenue, they have negative operating income each year. Their net income is a lot worse than their operating income due to these large items and other expenses. This is their income statement from their latest quarterly report. This is the first 9 months of 2020 versus the first 9 months of 2021. And this is the third quarter of 2020 versus the third quarter of 2021. The top line is research and development. That went from 17 million to 39 million. As you can imagine, this company is going to spend a lot of money in R&D. This is when their employees gain new knowledge to improve their current products or to create new ones. Part of R&D is the payroll and compensation for its employees, also amortization and depreciation. It can also include the cost of the equipment and the rent in the facilities. Below that is general and administrative. That went from 3.7 million to 14 million. G&A are mostly the costs not tied to making the product or service. An example is a salary for support functions like IT or accounting. Their operational loss went from 21 million to 54 million. They're paying a lot less interest on their debt. They paid 8.9 million in the third quarter of 2020. Now it's down to 359,000. They do receive a little interest on their investments. And the reason they have such a big loss in 2020 was a change in the fair value of their convertible preferred stock. That was negative 347 million. And the reason they have net income in the third quarter of 2021 was a gain in stock warrant liabilities. Warrants are options that are issued by the company. So the holder of the warrant can buy stock at a predetermined price. So say company X gave me warrants to buy the stock at $10, but the stock was trading at $8. I wouldn't buy the stock for $10, I would buy it for $8 in the open market. Once a stock started trading above $10, then I would exercise my warrants and buy the stock at $10 a share, even though it was trading at more than $10 a share. Warrants are dilutive, so it would add more shares to the open market. Options are not dilutive. Warrants need to be marked to marketed or valued. Since QS's stock price has decreased, it's less likely the holder of the warrant is going to buy stock and dilute to shareholders. So that's a gain for the company. And the way companies determine the fair value of the warrant, they use the Black-Scholes model. Until the warrant is exercised, the company will have to pass through a gain or loss onto the income statement every time they mark to market the warrant. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. And they spent the most in CapEx in the trailing 12 months, 93 million. CapEx and investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. The way they're funding their operations is a sale of common stock. They raised 276 million in 2020 and 839 million in the trailing 12 months. This is their operating cash flow section from their latest quarterly report, the first 9 months of 2020 versus the first 9 months of 2021. And the way you calculate CFO, you start with your net income or net loss, and then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So in the first 9 months of 2021, they had a $21 million gain. We have to add back the depreciation, the amortization. Also, we have to add back stock-based compensation. We passed through a gain of 169 million from valuing the warrants. So we have to minus that out. That's a non-cash item. And then we have to adjust for changes in working capital. Even though they reported a gain of 21 million, they actually lost 83 million of cash flow. And in 2020, they reported a loss of 400 million, but they actually lost 34 million of cash flow. Operating cash flow usually gives a clearer picture of how the company's doing, as opposed to net income. This is their investing section and financing section. So in their investing section, the top is property, plant, and equipment. That was 14 million in 2020, 82 million in 2021. They also buy and sell marketable securities. This is mainly so they can earn a little bit of interest on the cash that they have in their bank. In their investing section, they had a cash outflow of 400 million. In their financing section, they received 11 million from options, 151 million from warrants. They received 462 million from issuing common stock. It looks like they did another stock offering for 100 million, and they received 5 million from a finance lease. In the first 9 months of 2021, they had a cash inflow of 730 million in their financing section. So since they're pre-revenue and they're building out their products and testing the products, they're going to continuously need financing to pay all their expenses. But that's fine. As long as they're moving forward with the process, then investors will continue to buy the stock and put money into the company. Because the goal is they're going to eventually have a battery that works, that a lot of people want to buy, and that's going to generate lots of revenue and lots of cash flow, and hopefully the stock will go up at that point a lot. This is the equity section of their balance sheet. They have 1.7 billion of equity. They raised 3.6 billion from selling their business, and they lost 2 billion from running their business. Let's look at the capital structure. They have 1.7 billion of equity, 68 million of debt. So they're 96% equity, 4% debt. And they have lots of cash on their balance sheet, over $1.5 billion of cash. And I gave them the highest whack on Finbox, 6.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 8 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 8, that's $15 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $9.3 billion. We divide that by 423 million shares. And we get a calculated stock price of $22. They're trading at $24, so they're trading at an 8% premium. It's a sell according to the model. The global EV battery market should hit $155 billion of revenue by 2028. This company's CEO said in an interview they should have $6.4 billion of revenue by 2028. That's how I got the $6.4 billion. The battery is going through testing in 2022 and 2023. They should start to get some revenue in 2024. So I just backed into the $6.4 billion. That's how I got their previous revenue numbers. And the average company in this industry converts 10% of their revenue to free cash flow. That's how I got their future free cash flow. I multiplied their revenue by 10%. 4 analysts priced this stock and the average price target is 36. The low is 26, the high is 40. This is where the stock has been trading since it IPO'd. It was over $100 at one point. That would have been a good time to short it. Of course, hindsight's 2020. I say that now, but when I go to short a stock, then it goes up higher, so. But it looks like they're trading at the appropriate price right now. When people invest in a stock, they look towards the future. And nobody knows the future, so it's all perception of what the investor thinks. Last month, the company said it did testing on their 10-layer battery cell, and it looks like it passed all tests. It performed 800 cycles at 25 degrees Celsius, which is 77 degrees Fahrenheit. So this is a big win for the company because it met all milestones it laid out for this year. Now they can focus on their 2022 and 2023 goals. This was a good article about their 10-layer testing. So this article said, unlike SES, QS did not reveal the amperage nor the mass of its 10-layer cells. It only said that they achieved 800 cycles at better than 1-hour charge rates at 25 degrees Celsius, while retaining more than 80% of capacity. When this company did single-layer cells, the capacity retention was 90%. They're going to keep testing and increasing the number of layers. And they're going to start shipping samples to Volkswagen next year. And those samples should have a few dozen layers. And then by 2023, they're going to do real-world testing, which means by 2024, they can start mass production. Their competitor SES said that it gave up on solid-state technology because they said it was not possible to put it in production. Here's a timeline from one of their older presentations. It mentions a 4-layer testing, 8 to 10-layer testing, and we know they just completed 10-layer. Next year is prototypes and implementation, then testing in cars, then commercialization. So it seems like they're actually ahead of schedule, which is great. Here's a list of their competition. And QuantumScape uses lithium metal. So does SES, Samsung, and Ionic Materials. Solid Power is a public company. I'll show you their ticker in a little bit. So the automotive requirement is dozens of layers. SES was up to 25. Samsung only did 2 layers and Ionic 1. And Toyota is working on this as well. And Toyota is one of the largest car manufacturers. And I heard a rumor they're testing out this on some of their cars currently. If Toyota gets to the market first, that can really hurt QS's stock. Solid Power, ticker SLDP, market cap $1.9 billion. And this is from the company's website. We need a new breed of battery that looks, acts, and is built like today's lithium-ion batteries, but that comes with the benefits consumers and automakers have been seeking for decades. Longer life, increased safety, and lower costs. Here's another company, Ilika, ticker ILIKF, market cap $414 million. This is from their website. Ilika is a pioneer in solid-state technology, enabling solutions for applications such as industrial Internet of Things, medtech, EV, and consumer electronics. The stock went down a lot, 57% in the past 52 weeks, while the S&P went up 29%. The 52-week low was 19, the high was 133. And the stock is trading below its 50-day and 200-day moving average. Over 10 million shares have been traded each day on this stock. 32% of the shares are held by institutions, and it has a really high short percentage. Over 12% of the shares on float are shorted. A bullish sign is a company that adds employees, and they seem to have doubled their employee count in the past year. They're up to 475. If you put $10,000 into this company when it started trading, you would have had well over $100,000. But if you're still holding on, you'd be at $24,000 today. That's still a pretty good return on investment, 142% total return. This is something investors don't like to see, a lot of insiders selling their stock. And it's mostly sell orders. There are 2 buy orders, the rest are sells. Institutions own 30% of the stock, same thing with the general public. Public companies own 20%, insiders 11%, VC firms 7.5%. Volkswagen is the biggest shareholder at 20%, which is equivalent to $2.1 billion. Then Khosla Ventures, the CEO of the company, owns 4.3%, then Vanguard. Let's look at their financial ratios. We can't look at the PE since they have negative net income. We can't look at the price of sales since they have no sales. Their price to book is okay at 6.1. That's stock price over book value per share. Here's a list of their long-term assets. $136 million of property and equipment. This is net of depreciation. $37 million of financing right-of-use assets and $23 million of operating right-of-use assets. A right-of-use asset is when a company leases an asset that someone else owns. So instead of buying the asset outright, you can lease it from someone else. And it's carried on a balance sheet as an intangible asset. And it's amortized over the life of the contract. The company who's leasing the asset out carries it on their balance sheet as a liability. If QS is using a financing lease for a piece of equipment, at the end of the lease term, QS will retain ownership of that asset. If there's another piece of equipment they're leasing from someone using an operating lease, then they have to give back the asset at the end of the lease term. Also, financing leases are usually longer than operating leases. The lessee has to maintain the asset in a financing lease. With an operating lease, the lessor needs to maintain the asset. They have a really high current ratio and quick ratio. It's almost 43. They have $346 million of cash on their balance sheet, $1.2 billion of marketable securities. In their current liabilities, they have $22 million of accounts payable, $6.4 million of accrued liabilities. So you can see they don't have much in current liabilities. They have a ton in current assets. The reason their current assets are so high is because of the IPO. They received lots of cash. So they're really well capitalized. They should have enough cash to get through the next few years in order to make it to production. In the trailing 12 months, they had negative $200 million of free cash flow, and they have $1.5 billion of working capital. Working capital is current assets minus current liabilities. So they have $1.3 billion of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 10 companies in the same industry as QS. Obviously, they don't have good ratios since they're pre-revenue. We can't look at the PE or price of sales. Their price to book is higher than average. They have an extremely high current ratio. They're not bringing in any revenue, so they have negative net income. And they're really low in debt. Companies that aren't bringing in revenue tend to not have much debt. But they're not a small company, 10 billion market cap, which is a little smaller than average. But for a company that hasn't brought in any revenue yet, that's pretty high. So to summarize, I have them trading at an 8% premium, but I'm pretty bullish on this stock. I think their technology is amazing. They've already proven a lot. Obviously, they haven't started production yet, but so far all the testing they've done have been successful, and Volkswagen seems to be happy with it. But generally when a stock starts trading, there's a lot of excitement and people start buying. But there's lots of people who owned the stock before the company went public that want to cash in. So they sell off their shares, and that's why the stock price comes down. And then people get nervous who bought in at the height and they sell, which brings the stock price lower. So I think it will come down a little more because it's going to be at least another 2 or 3 years before we see any revenue. And people get a little antsy. If they don't see revenue, they don't like to hold on to things. So I think there's a little more downside to this stock. With all of the demand for EV batteries, there's really no reason the market cap can't get up to 100 billion, if not a lot higher. I rank their free cash flows revenue ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.